Inflation. Specifically, we're going to uncover the economic forces behind the 2020 surge in inflation. From the COVID-19 outbreak to the recovery of energy prices, we've got a lot to cover. So let's break it down and make sense of what's been happening. When COVID-19 hit, governments worldwide imposed strict restrictions to minimize the spread of the virus. Western countries were no exception. Lockdowns and mobility restrictions led to a sharp decline in economic activity. Personal consumption dropped significantly, especially in crude oil. In 2020, personal consumption fell by 12.7% in the EU, 20% in Spain, and around 12% in Italy and France. With less consumption, the gross domestic product, GDP, in the euro area plummeted by 6.7%. Now, despite this economic slowdown, inflation started creeping up. By August 2021, inflation in the euro area hit 3%, up from minus 0.3% at the end of 2020. So, what's driving this inflation? One major factor is energy prices. During the pandemic, energy prices, especially oil, took a massive hit due to reduced demand. But as economies began to reopen in 2021, energy prices rebounded sharply. This recovery in energy prices played a significant role in pushing inflation up. Another factor contributing to inflation was the reversal of VAT reductions. During the pandemic, several European countries had reduced VAT to stimulate their economies. However, as conditions started to normalize, these reductions were rolled back, adding to the inflationary pressures. You might think unemployment would also play a big role in this inflation surge. Typically, there's some correlation between unemployment and inflation, but in the case of the euro area during the pandemic, this correlation was very weak. Turning our attention to the US, the situation had its own unique twists. Small and medium enterprises, SMEs, were hit particularly hard by the COVID crisis, with failure rates significantly higher than larger businesses. This decline in SMEs led to a decrease in supply from these companies, contributing to a reduction in world exports. This supply chain disruption added another layer of pressure on prices, driving inflation higher in the US. In summary, the surge in inflation we've been witnessing since 2020 can be attributed to a mix of factors. The initial economic shutdowns and subsequent recovery played a huge role, especially in terms of energy prices rebounding. VAT adjustments and supply chain issues, particularly the impact on SMEs in the US, also contributed significantly. Given the facts presented above, it's clear that investigating the link between inflation and the macroeconomy, particularly with respect to oil prices during recent crises like COVID-19, is crucial. Moreover, with UK inflation hitting a 41-year high, there's a looming threat of the economy facing its longest recession in history. To address these concerns, the video delves into the influence of inflation in the United Kingdom, UK, on key factors such as gross domestic product, GDP, trade balance, unemployment, and Brent crude oil prices. However, Brent crude oil shocks appear to rebound the fastest, reaching a positive level in just 1 month compared to other indicators. Except for certain crises like the European sovereign financial crisis in 2012 and the second wave of the COVID-19 epidemic, the percentage change in unemployment consistently declined. Particularly for short-term economic activities such as business investment, consumer spending, and employment rates, understanding these dynamics is essential. Therefore, examining the connection between oil prices and inflation offers policymakers crucial insights into controlling inflation. By analyzing these dynamics, researchers can illuminate the potential implications of oil price shocks for different economic sectors. Furthermore, research on inflation, oil prices, and other economic factors can aid in constructing macroeconomic models to enhance understanding of global economic behavior. When the COVID-19 pandemic struck in early 2020, the Federal Reserve responded swiftly and decisively. It slashed its short-term interest rate target to nearly zero in March 2020 and maintained it at that level until March 2022. Additionally, the Fed resumed purchasing large quantities of U.S. Treasury and government-backed mortgage bonds through a policy known as quantitative easing, while also providing forward guidance on the future trajectory of short-term rates. Alongside substantial fiscal policy measures and the rollout of newly developed vaccines, this aggressive monetary policy stance contributed to a robust economic recovery. However, it also brought about an unexpected and persistent rise in inflation, with the Consumer Price Index peaking at nearly 9% year-over-year in the summer of 2022. The actual rise in inflation in 2021 and 2022 was largely propelled by factors directly impacting prices rather than wages. These factors included sharp increases in global commodity prices and sector-specific price spikes resulting from pandemic-induced disruptions to supply chains and a significant shift in demand from services to goods. Fiscal policy did contribute to inflation, but its primary impact was on consumer demand for commodities and goods in limited supply, rather than on labor market dynamics. According to Bernanke and Blanchard, as tight labor markets begin to exert more influence on prices, restoring balance in the labor market will be crucial to bringing inflation back to the Fed's 2% target. Whether achieving this balance will necessitate a significant increase in the unemployment rate from its current historically low levels depends on the ability to restore equilibrium in the labor market without triggering widespread layoffs. Disrupted during and after the pandemic can return to pre-pandemic levels. According to Clarida, broad-based price and wage inflation occurred when conventional metrics indicated that the economy was operating below its potential. Which was the greater transgression, excessive fiscal stimulus or excessive monetary stimulus? Furman didn't mince words. He pointed out that while fiscal policy may have been quantitatively larger, especially in 2021, the more concerning error lay with monetary policy. He elaborated on this, highlighting that the fiscal decision was essentially made in January 2021, although it took another 2 months to pass. At that time, the trajectory of the economy was still uncertain, and there was ambiguity regarding whether it would experience a complete bounce back or continue to struggle. He went on to suggest that nothing the Fed could have done would have prevented inflation from rising in managing inflationary pressures, and underscores the importance of timely and appropriate policy responses in navigating economic challenges. Thanks for watching. Please like the video, press the subscribe button, and also drop your thoughts in the comments section.